but you'll definitely want to talk to your accountant and lawyer about putting an agreement in place if you don't have one. So buy-sell is a methodology or a mechanism to take care of a shareholder that is no longer with the company, whether he passes, whether it's an illness, whether it's a disability, whether it's a retirement, whatever the case may be. It's a way for a shareholder to exit a business so that the remaining shareholders remain whole. Ideally, that's what it's about. Anything you want to add to that, Liz? Hi, everyone. Hope you're having a good day. It's George and Liz back with you. And today we're going to talk about buy-sell agreements. So corporations that have shareholders will want to have a buy-sell agreement. And if you don't know what a buy-sell agreement is, we'll just quickly describe that. But you'll definitely want to talk to your accountant and lawyer about putting an agreement in place if you don't have one. So buy-sell is a methodology or a mechanism to take care of a shareholder that is no longer with the company, whether he passes, whether it's an illness, whether it's a disability, whether it's a retirement, whatever the case may be. It's a way for a shareholder to exit a business so that the remaining shareholders remain whole. Ideally, that's what it's about. Anything you want to add to that, Liz?
Yeah, I mean, I think speaking about the importance of them. So it's really important to have that planning in place from when you start or form that company. So as soon as you have more than one of you in that company, having an exit strategy really is what this is about, and having a way that you can make sure that that exit strategy is funded. So we're going to talk about different ways of funding in a moment, but I just want to talk a little bit about the importance. So sometimes there are things that people don't necessarily think of, but in terms of what could happen. So maybe the person has a change of circumstance. They either become disabled or they just need to move away for whatever reason and they can no longer be part of the company. So having a strategy as to, enable those life things that happen, it's really important to have that and have an agreement about that ahead of time. Other things that can happen is, unfortunately, people can pass away. And often that's not really thought about, because what actually happens if there's no agreement in place and someone passes away is often that can mean the spouse of that person now suddenly becomes part of that company. Now, that spouse may have heard about what was going on in the company, but not actually being part of what was going on in the company. And I've actually seen that play out in the complexity that could create. So the spouse is grieving and may not necessarily want to be making business decisions, and the business partners that remain may not necessarily want to have somebody who doesn't have that track record or understanding of how the business should go as a partner in the business. And so that becomes problematic then in terms of how do you solve that problem in terms of, making sure everybody's looked after appropriately and everybody has, their contribution fairly accounted for in terms of that. So that's a really important thing that people often don't think about, and that can unfortunately happen at unexpected times. And then maybe there's another time where somebody wants to retire or go and do something different, and you want to make sure that they can easily exit from their part of the business without collapsing the business. So there might be people who are staying in the business who want to keep it going and keep it growing, but if there isn't the capacity to let somebody exit easily from the business, then that can be problematic and the whole business has to fall apart. So, I think it's important to understand that we don't know what's going to happen in our business or the trajectory of our business when we enter. So we want to create a situation where we can cater for a variety of different circumstances, because having that in place gives us confidence within business to be able to deal with whatever is the unexpected as it comes up. And also you as the person who's entering into that, you may need one of those options yourself. So you may wish to exit and go and do something different. And so it empowers you as well, not just your partners that you're going into business with.
Yeah, well said, Liz. Often when we start a business, we don't think about what are we going to do when we want to exit it. What is the exit strategy? It's generally the last thing you think about. But it should definitely be part of your planning, and do it early, do it right away. Because when something unexpected occurs, you have to deal with that. So you want to have an agreement in place well ahead of time, well thought out, in order to deal with that situation. So with the buy-sell, the idea is that you're going to buy or sell your shares, or someone is going to buy your shares when you no longer want to, whether it's intentional or not intentional, be a part of that corporation, that business. So there's different ways of funding that ability for the remaining shareholders to purchase the shares that are now available for sale. So one of them, of course, is to use the money that's left over in the company. But is that the best option? What if you don't have enough money to buy those shares, depending on the share value? Over time, those values are going to grow enormously. Millions of dollars we're talking about here if it's a good sized company, and you need to have the funding available to purchase those shares from that shareholder that no longer can be there for whatever reason. So
and I think
using
really
cash is
not
not necessarily your best option. Go ahead, sorry.
Oh, sorry, George. Yeah, I think the thing about that is understanding that it's not an efficient use of cash to store it for the just in case, right? Like a very few businesses as they're growing would be able to put aside that amount of capital in cash to cover the eventuality of a shareholder, choosing or not choosing to leave. So it's not an efficient use when there's so much demand on cash within a business to continue to grow it or to fund equipment or whatever else. So that's where, putting that money aside is probably not a super, easy option for any kind of growing business.
Yeah, for sure. Great point. Another way is, of course, financing. So the corporation can look for financing from a third party in order to pay that bill, that debt, if you will. Now, of course, what are the problems with financing? So first of all, you have to qualify. You have to get the bank to agree to give you money. Banks generally don't like to give you money when you need it. They love to give you money when you don't need it. So if you're in a desperate situation and you're trying to deal with a sudden loss, going to a bank and with hat in hand and trying to get some financing so you can buy your shares may or may not work very well. Certainly not in your favor. So that may not be the best option either. You want to talk more about that, Liz?
Yeah, and I think the important thing to understand around financing or any of these strategies is generally the business partner who is exiting had a certain amount of value for that business. So if you look at the valuation of that business, it may well have changed if that person was significant to the growth and revenue of the business. So if you're going to remove the person, then you're also removing some of that revenue until you either bring someone else up to speed or have some other kind of succession plan in place. So understanding that putting yourself in a position of taking financing when perhaps your revenue is actually going to take a bit of a dive for a time until you bring somebody else up to speed may not set you up for financial success in your business either. So it's, understanding that's the challenge of, especially if it's happened unexpectedly and you hadn't planned for that person to leave because of some unfortunate circumstance. How do you cover off that period of time and the connections that they had and the things that they did to generate and grow the business? That's just going to create some draws on some cash. And so if you're then trying to add financing on top of that, that can be problematic because you may not have what you need to be able to go and support to the lender that you actually have the capacity to service that financing. So that can be a big issue with looking at using financing for that solution.
Yeah, great.
Which I think
great
leads
point.
to something else that people often then end up having to do is they say, well, we'll just sell off some assets. Well, that's great if you can afford to do that, if that's not going to cause you a detriment to your business, and even if that's a good time to do it. So, kind of like depends on what the business is, but I think we're all aware that, there are cycles in business and there are cycles in markets and things like that. And if you sell something at the bottom of a cycle, you may end up having a bigger realized loss than if you sold it kind of at the top. And I think, we've brought up enough times to say you may not be able to choose that time. So, the timing may not be what you expect, and it may not be to the best interest of the business to have to sell those assets, during that time. So, I think what the theme that we're talking about today is making sure that you have a plan so that you're actually optimizing and putting yourself in the best position. And so we have a tool that we like to tell people about and talk to people about, and it's actually very powerful in buy-sell agreements and may not well be known, but it's actually something that, you know, as you're talking to your lawyer about it, they can actually make sure that you're doing it collaboratively and putting these in place at the same time as you put that buy-sell agreement in place, so that you're building this structure, but also building a way that you can access that capital on an ongoing basis in your business. So I think that's really key, is we actually want something that's going to be useful to us, not just when the event happens of, you know, enacting this agreement, but something that's going to be useful throughout the business, that we can be, you know, growing our capital and using it more efficiently in that way. You want to talk a little bit about that, George?
Sure, absolutely. Just to add to what you were saying as well, you made a great point. Selling assets. I mean, anytime you're forced to sell an asset, the buyer knows that you are desperate. You're never going to get full market value for that asset. So you never want to be forced to sell an asset when you don't want to and don't have to. So definitely can be detrimental to the business. So what Liz is alluding to as a fourth option to finance your buy-sell agreement is insurance. So in the case of a shareholder passing, we have life insurance. In case of a disability or critical illness where they can't be part of the business any longer, you know, there's disability and critical illness insurance to cover that off that eventuality. So the idea here is that you purchase insurance. It can be through holding companies, which are ideal. The operating company can pay for the insurance. And when or if someone can no longer be a part of the business, the insurance is there to cover off the cost of purchasing those shares. So the amount of insurance has to equate to the value of the shares. So it has to be updated on a continual basis. But certainly you want to have that insurance in place well ahead of time and have enough insurance so that you can cover off the costs of purchasing those shares. And then you don't have any negative impact on the business or the owners that remain. So it's very, very smooth, effective use of your capital. Yeah.
And I think one thing that I often get asked about with regard to this, George, and I'm sure you have something to say on it too, is a lot of people will say, well, why not use term insurance? Because it's a super cheap way to add insurance into the business. And sometimes, absolutely, when the business is starting out, that could be part of the solution. So I'm not saying that it couldn't work. The challenge with term insurance, and you kind of alluded to that in what you said earlier, is the amount of insurance in term insurance doesn't grow. It stays the same. So you buy a certain amount of term insurance. So as the business grows, it doesn't kind of keep pace with that. So you may not have enough in place to do that. The other issue with term insurance is if we've been in business for 10, 15, 20 years and it's time to renew that term insurance, the 20-year mark, each of those business owners are 20 years older. So the cost of that in term insurance gets much, much more expensive as we age. So that also becomes a less beneficial option at that stage, just because the cost keeps increasing to the business for that. So putting something in place that enables you to sort of grow the value of that insurance. But also the other really important part of that is having something that's going to be sustainable for the business long term in terms of the amount of premiums putting in. So putting an amount that you know and you can, you know, account for that in your business, that's the amount of money that's going in. But most importantly is the cash value that you can actually use within your business during that time. So with term insurance, you're not actually building up any cash value, but with a properly structured whole life dividend paying participating policy, you can actually be building that cash value that the business can be utilizing throughout for whatever the expenses are and covering off costs. So it, you know, just provides an extra layer of possibility in terms of use within the business.
And those are great points. One thing to consider too is, so you're growing capital that can be used for whatever purpose you choose. So you're going to have the insurance in place to cover off the eventuality of having to buy out a shareholder. And that's long term. And you're locking in the cost today and the value is growing over time. And you can use the capital during that period of time as well. So multiple benefits to putting this solution in place to take care of the problem of funding your buy-sell. So it is by far the best option to fund your buy-sell, and there are additional benefits that go along with it. It adds to your balance sheet. On the positive side, it can actually add to revenue for your company as well. So there's so many positives to this solution, and we'd be happy to get into more details with you when you're ready to talk about it.
If you'd like to learn more, click on the link that appears below the video. And as George said, we'd love to have a conversation with you about it and how you can fund your buy-sell agreement for your corporation.
All right. Thanks a lot. Talk soon.